Hello everyone, welcome back to Topstep, the London session. My name is Deeyana Angelo. I've been trading for 17 years and 12 years out of that I've been trading futures. Okay, let's see what we have today. So first things first, we are starting to the rollover in gold. So if you saw how copper has been the last few days, it's been quite lackluster. As soon as that rollover began, the volume was split between the old and the new contract, and that led to, well, moves that were mainly range bound, but it was even worse than that. It was just like such a tight range that it's very difficult to find any sort of great moves until the rollover is complete. So now after this massive smash down yesterday in gold, I would expect to see some lackluster movement there too until the rollover is complete. And when it comes to the rollover, we are rolling into February. So if you go on the CME website and you go into the quotes section, so usually when you Google CME GC, it's going to bring you to the overview screen. But what you want is to have a look at the quotes, right? And there you will have this column that says volume. So when you start to see the volume rolling into one of the next contracts. Now, sometimes it will roll into the next one. However, gold very largely likes to skip over a couple, and then it rolls into months that are sort of 2 and 3 months out. So just keep in mind, if you're going to be trading gold, I'm probably going to skipping that, and I'm going to be limiting my screen time for a number of reasons. First of all, I'm having a bit of a flare-up of my stupid disease. And second of all, one of the reasons why that's happening is because we have still having like house viewings, and that's sort of putting a bit of a wrench in the works in what I'm doing. So just to limit my own exposure to, screen time, I'm going to be locking up some of the day. Now, how do we do that? Well, I'm happy to show you that we have some new features. Let's get rid of this. Whoops, I've just got rid of everything. Here we go. We have some new features, guys, which are pretty exciting. Now, I am going to bring over the simulator thing because I don't know whether you can see, but I've already locked myself out, and I'm going to be unlocking myself after the first hour of trading is done and a little bit over for the NYMEX session, when my edge is the biggest for some of these products. Since we still don't have DAX, and actually that brings me to another point. Let's push DAX. Let's push DAX. Okay, so this is a post that is a direct post for Simply Funded, which is a company that's working on Project X. And so if you click on the link that I've just posted, you can go in there and you can upvote the Eurex so that we can try and push it higher up into the relevance. And maybe if we can get it to 400 votes, maybe they will give it to us. But for now, they just keep pushing it. It was supposed to be July, then they pushed it to September, then to November, then to end of the year, and now it's end of February. So let's try and get that upvoted. Now, when it comes to the new feature, let me just find another screen. Let's bring over this one. So what's new? Well, what's new is that you have the manual lockout, which we're all very familiar with, right? But now it looks a little bit different. Confirm trading lockout, and you can now select from the following options. You have 15 minutes, 30 minutes, 1 hour, all day. But here is what I like to do. Custom. So I click on custom, and then I will specify the time of the day when I wanted to unlock me. So for example, if I wanted only trade after the initial balance is over in NYMEX, and maybe after the first 30 minutes of potentially the C period in TPOs, I will say that's 3:30 my time. So I will specify 3:30 p.m. and it's going to say it's going to unlock me in 5 hours 52 minutes. Okay, so if I click yes, lock me out, it's going to lock me out, right? And then you're going to get an additional clock, and it's going to say lockout ends in X amount of time. So it's a pretty nifty feature for anyone who is struggling for a particular time of day and you just want to lock yourself out. Now, going forward, I would like to see some more of these features getting developed, and I know that they're working on it. So, for example, I have the position size control in some of my other platforms, and that's really handy because it prevents you from going into sizes that are inappropriate for some of the account balance that you might have at the time. So, for example, if you go over the 1.5K buffer in any XFAs, what's going to happen is that they're going to unlock the full size number of contracts, but that's not necessarily a good thing because 1.5K in my eyes is still nowhere near enough to start sizing up. Now, I've been guilty of this as well, so I'm not fully immune from that, which is why I do have risk controls on my other platforms where I don't even think about it, right? I just have it set. So that is something they're working on. I did have some replies from Patak where I asked him whether the position sizes are next, and he said, yes, we are pushing that. And, sometimes you can't really rely on yourself to be fully disciplined. Life happens, things happen, and at the end of the day, fat finger trades do happen as well. I've done stupid things like thinking I'm trading micros and then I'm trading full contracts. And instead of, 5 micros, suddenly I'm in 5 full contracts. And that's going to wipe out a grand and a half, literally in minutes, if not seconds in some cases. So because of that, having these risk controls in place to stop you from doing something like that would be, they would be very, very beneficial for everyone. And Topstep is one of the very, very few companies that recognizes that. Now I can see a question here. Lockout without flattening would be awesome. Yes, interestingly enough, I have that on NinjaTrader. So we have a plugin over there that is pretty nifty, and it allows you to lock yourself out from new positions, but to keep the existing position going. So again, all of that will be coming to Topstep X, which is amazing because they're doing all of that free of extra charges. So as soon as you have a combine or an XFA, that's all included as normal. I've never seen a proper company do that. And I know that some of you guys are like, oh, but you work for Topstep. Well, I'm a contractor here. And one of the reasons why I am a contractor here is because I've always recognized the Topstep mission to educate traders and to make them better. Yes, it's a business. Yes, they are here to also generate revenue. However, their revenue comes from many different sources, like most companies. And that is why I've chosen to accept this position, right? So we're all here because we see great value in Topstep. Not to mention that Hogue was one of my big, big mentors, and he was very kind to teach us all, to let him... this was back in 2015. Now it's a long time ago. But yeah, when I first met Hogue, I was shocked at the level of openness that he had. He never hid anything. He was always like, hey, what do you want to know? And then I would ask him a whole bunch of questions, and he's like, well, let's try that trade. Let's try that trade idea. That's an excellent question. Let's see how that works. And then he would run you through a practical side of things. He continues to do that in the group coaching sessions. However, back then we only had the audio, and the charts. And actually, from like as soon as this nonsense with my house selling and stuff is over, I'm actually thinking of bringing back my own daily live streams on my own YouTube channel, because I think I am better to like I'm better to the point that my energy levels might enable me to do that. However, it's probably not going to be the full kind of video and stuff and everything, because I want to be able to still sort of put my legs up and rest. So maybe just do the audio. I do have a laptop with multiple screens that might enable me to do that. And I have one of those Asus Duo screens and 2 additional screens as well. So really thinking about that. Whether it's going to be open for public, I'm not sure, because when I was still doing it a while back, we used to get a lot of randoms. So, I need to see how I'm going to run that and whether it's going to be open for public or not. So yeah, I'm probably going to plan that for maybe January or something. Maybe a little bit earlier, depending on how all the things that are going on in my life currently transpire. So yeah, we'll see. But, if you are interested in that, there is a link to my channel down below, which you may want to check out. But I know a lot of you are already subscribed. Let's tackle some of the questions. Mo says, Deeyana, sorry to be a pain. No, you're not a pain at all. All questions here are very welcome. If you don't know anything, something about something, feel free to ask. That's what we're here for. So Mo wants to know, what is a rollover and why does it matter? Okay, so futures contracts 101. They run in either monthly or quarterly contracts, depending on what you're trading. I am specialized in metals and energies, and by default, those contracts will roll nearly every single month. Now, there are some caveats there where if you roll into, 3 months contracts ahead, because of the way the requirement for that particular commodity states, like for example, we have Christmas, right? It's all very logical when it comes to the underlying futures markets. So for example, we have Christmas. What happens at Christmas? Well, a lot of people buy jewelry. So what's going to happen with jewelry stores is going to mean that they're users of gold, and therefore they will have a lot of requirement for the delivery of jewelry. So they will need platinum, they will need gold, they will need precious metals in general. That means that when we were still in August and July, gold actually rolled into December immediately, skipping over several contracts. And when the rollover starts, you have split volumes. So if I go onto the CME website, I'm going to bring this back up again and go into that quotes section. So what happens to volume? Well, if we see December contract, which is the current front month, that's the suffix that you see here. Now, all of the suffixes, they do have their designated letters. So December is Z or Z if you are over in the United States. And, they don't really have any rhyme or reason to them, but they do have designated letters, suffixes. Every month has its own suffix. 4 designates the year and Z designates December. But let's have a look at this volume column. So usually GC should have, 86,000 contracts, 100,000 contracts traded. And look at what's going on now. December only has 49,000 contracts trading. Now February, which is what we're rolling into when this month expires, and it expires, every month, it will roll into February contract, and we already have nearly 40,000 contracts trading over there. So what do we have? We have split volume. Now that leads, not always, but it will lead to some lackluster movement. So if you're looking for big momentum trades, yesterday we had some headline risk, which brought gold down massively, because I think they thought there was a ceasefire or something, and that does happen. Gold is a risk product, as is crude oil and equities to a degree, depending on what's happening, even though equities typically fall more when there's wars announcing. So that's risk off, which means equities go down. And traditionally, some of these risk products like gold, crude oil, they will go up. Upon the ceasefire information, news, potential, everything went into risk on sentiment, which means crude oil and gold falling and equities potentially not reacting too much, because that's not really something they're interested in. It's like, it's not a big risk event. It's like, yes, there's a ceasefire, that's good news, but does that mean that they're automatically going to smash into a massive day higher? Probably not. It's a different product. They have different relationships with some of the underlying other asset classes, like the fixed income products like bonds and stuff. And currencies as well. Currencies can react pretty heavily, especially yen, to some of the risk events. So just keep that in mind. But when it comes to the rollover, the main reason why we're not that keen trading rollover, and why I'm terrible, absolutely terrible on rollover weeks, and I should probably just not trade them, is because this volume split between two contracts. So suddenly all the people who were trading that one contract, they're now trading partially in February, partially in December, and it can lead to range-bound moves, very, very small initial balances. Now, initial balance is the first hour of any exchange open. Right now we're in London, and that happened about, nearly 2 hours ago now, but I never trade the open. I think the open, especially in London, is not really that conducive to my style of trading. And I do need follow-throughs of the movement, whether it's range bound or a breakout trade. I still need follow through. Now, during rollover, traditionally you don't get that. So it all becomes sort of territory where you would scalp like 15 to 20 ticks. And I absolutely despise doing that. Because I think in the long run, the math isn't mathing, right? So I am not somebody who sits here for 8 hours a day. I like to do other things whilst I'm in my positions that frequently will last anywhere from 45 minutes up to 4 hours in some case. When the things are not in rollover and when we do have some dedicated movement, by staying in positions longer, I'm able to get my higher risk reward, which floats around 43%. So when you see me doing lives and stuff, it will look like I lose most of the trades. Why? Because of that 43% accuracy. Now, I have had weeks where I've smashed it at like 80%, 75, 90%, but those are outliers for me, and it almost always means that I'm changing something and that I'm effectively taking less profit, which is sometimes negative risk reward, but then I always find that it eventually comes back to bite you. The negative risk reward is something that I've never advocated for, because I've seen over and over that a very small amount of individuals can actually maintain over 70% accuracy, which would be needed for the negative risk reward. That's very difficult to maintain for years on end. So I'm somebody who's been trading for 17 years. I haven't started yesterday, and I've seen how those sorts of systems are just not that stable because the human malfunctions, right? Maybe if you were market making back in the day where you could see what people were doing around you and you would just grab a tick or two, you would be happy. And of course, there are market making positions as well where people I actually worked for a market making company briefly because I didn't like it. You go there and they say to you, today you have to fill, let's say, 500 contracts, 500 lots. It needs to go out. That's what market making is. And you simply don't have many options but to do a lot of trading on the day. So it's very labor intensive, and I felt that if I was a market maker, I would look very differently now at nearly 44 years old. So it would probably look like I'm 60 or something. And I think that my stress levels will be absolutely through the roof. So for me, it's not really something that that I advocate for. So positive risk reward, even if it's like 1.4R, it doesn't have to be like 2R or something crazy, or 2.3. Like my own accuracy floats between about 1.4 all the way up to 2.3R, depending on what's going on in the markets and how I'm able to take advantage of that. But nearly always I start all of my coaching clients with 2 or multiples. And very quickly, once they glue themselves away from those one-to-one opportunities, they start seeing their P&L curve go into positive. You know, it goes from a frown to a smirk. And that's always a good thing. Shubham Singh says, I think market replay is a great feature for practice. What's your view on it? Yeah, interesting that you say that. So when I was still a new trader, I spent probably a few months using my weekends to run a replay feature on something that was called Forex Tester back then. Now, I know that they've kind of come along in years, but I didn't really like that platform. Interestingly, they did approach me to do a review, but you know, I still had sort of nightmares and scarring from trying to generate tick data back in like 2008-9 when I was still practicing. However, if you're somebody who's struggling with, let's say you want to have an entry technique that is more systematic. No, Bernie, I'm sorry, I've got Bernard in here, the big boy, and he wants to look out the window, but we cannot do that right now, okay? So if you hear moaning in the background, that's Bernard going, I want to look out. No, we work, okay? Lie down and settle, please, okay? So replay feature is very, very good. So let me give you like a practical example. I use the 100 tick chart for that, for some of my entries. So let's say you want to enter after a bounce from VWAP using a 100 tick chart. Well, what you would be waiting for is for the market to rise up to overnight VWAP first and foremost, and then to go under my little ribbon that I use as a timing tool. So how would you practice that in a replay? Well, you would make sure that your level is reached, and B, that you only enter once the price crosses over the ribbon. And you have to wait until that event happens. Anything before then is just guesswork. It's crystal ball territory. It's like, yes, I think it's going to bounce. You don't know that. You can use statistics to say, yes, we are going to reverse from that area by the rate of, I don't know, let's say 66%, which is something you've observed. But then it comes down to the human to make sure that you have the actual entry systematically. Okay, it's not easy to do at all. Like even after many, many years of doing that, sometimes I still forget, you know, if I'm a bit sleepy, I haven't had enough caffeine, I will still be like, oh, VWAP short. No, that's basically your human brain going, well, I think it's going to go this way, so let's just click. If you're a systematic trader, you need to have a clearly defined entry. And if it so happens that it touches VWAP and it goes all the way away from it to the point where you would need a much bigger stop than you planned, it breaks the systematic rules. So it still needs to bounce within a fairly kind of tight number of ticks. Anything over that and your risk parameters change. So if you need to use a larger stop loss, you need to use a smaller size. Now, sometimes you can use a smaller stop loss, but for the most part, the problems arise when the level bounces too much. So that's something you can practice in replay, okay? If it goes too much, you're like, no, that doesn't match my system. Don't touch. And then you go to the next day and you do a replay again. And you're like, okay, so now let's see if I can get in. And you keep doing that. And you can also do it slower. You can do it faster. So what I used to do, I used to practice entry patterns to, let's say, wait for a 2-minute really strong engulfing pattern before I would enter. It would be a 2-bar reversal from my designated level at a particular time of day as well. So because of that, I was able to actually use my musician methodology. So what I was doing is first I practiced very slowly. Then I started to go to sort of near real time. Then I decided to overshoot near real time, so by quite a bit. So basically increasing the tempo, thereby practicing to see the market faster. Now, many of you have seen me use these entry techniques before, but like I said, there's an accuracy thing. There's a time of day component as well. You know, I mainly trade DAX for this time of day. Most of these products that we trade here, they typically only really start to move for my style of trading in the overlap. So that, you know, that kind of introduces a bit of a more troublesome time of me trying to find setups that I know don't work particularly well for London for these products. But, you know, that's an entirely different problem. But if you get to a point where you just want to practice entry, replay is an amazing feature. So what I did is to practice it faster eventually. So very slow, real time, and then faster and faster, so that when I came to the real-time markets after the weekend, everything looked in slow motion. That's why, for the most part, I can talk and look for my setups because I've trained myself to see the markets much quicker. And then, you know, all of this to me just looks like it's dragging. It looks like it's in slow motion. And that's, when you get to that point, that's what you want. Now, some products like NASDAQ are absolutely crazy, and, you know, I can, like, you know, you guys have seen the reversal challenge, you know, I did win it, so I can trade it. It's just a personal preference. I really don't like it. So, you know. All right, lots of questions, so let's just go through some of them. Hi, Dee, do you use session TPOs? If so, are they different for different products, especially US at CME, NYMEX, and COMEX? Ours are different. What times do you use for London TPO? Okay, so London doesn't have different sessions, unlike the New York session times. So when it comes to trading all of these products, your TPOs, your initial balance, your value areas will always be the same. So same start time, same end time. Now for me, I use London Open, which is 8 a.m. However, I cut it off at the designated exchange open. So when the next major exchange opens, that's when my calculations end. I can do that through my BlackTech indicators. That's my company. I have a software company. I have an IT recruitment company. I have multiple businesses that I run. I am a businesswoman. But basically, when it comes to the software side on trading or in trading, we have a very, very good tool, which is BlackTech MP, market profile, that allows me to change the schedules. And we are actually working on Ninja version of those same things. We're actually just working on market profile at the moment. And we want to stay on Topstep X for these particular sessions. But just quickly, you know, to give you an idea of the functionality that exists for my BlackTech market profile. I have a small team of developers who help me do this. So here are the schedules. So we actually created quite a few schedules, and this is TPO schedule 1, which is a main session for gold. I started at 1:30 p.m., which is when COMEX typically used to open at 1:20 p.m., but I've tested those extra 10 minutes. It really doesn't make that much difference. And also back in the day, many platforms wouldn't allow you to start on the 10-minute mark. These days, the way we do software development is to effectively take a 1-minute data and to consolidate that into whatever time frame you want. So that's changed. You know, now you do have platforms where you can start these whenever. However, generally, it doesn't make that much difference. It's like sometimes it's the same, other times it's a couple of ticks difference. And then what I do, I run it all the way down to the end of the electronic session. Now for London, that's schedule 2. You will see that it starts at my 8 a.m. I am in London, that's GMT time zone. So it starts at 8 and it then ends at 1:30. Now that allows me to get just the value areas for London. And I can even change the schedules. So right now I have all of them as an overlap, including the developing one. But if I get rid of the other sessions and just have the London session, so I'm just going to clean this up a little bit so you can see this clearly. I'm also going to get rid of the volatility bands. There we go. So now you can see that I have the value area, which is this these purplish reddish lines, and it's all the way up there. So we have a potential for partial mean reversion, and right now you can see the TPOs are creating single prints. So you can see them on the graphical overlay, which is here. And actually a lot of companies have gone on to copy us, because I was the first one who wanted the TPOs on the chart itself. Usually you have a different window, and I said to my team, guys, I want it overlaid on the candlesticks, because I use a combination of the two to gauge what's happening, what sort of movement we have. So yeah, it's very, very optimizable. It's got a lot of functions. So that's what we've done, and that's what we're trying to bring into NinjaTrader as well, even though before I was not really in favor of Ninja, because they were still stuck in the old ages on very, very old versions of C#, but they have moved on, and they have actually brought it back up. It's still not the latest C# version, but it's doable. So there's still some features that we cannot do because of that. So, you know, it's a work in progress. It's always a challenge to bring and, you know, do the entirely effectively similar but new architecture into another platform. So that's what we're working on. But basically, yes, I do use separate TPOs for separate sessions. I do not mix and match. And in fact, if you go to Edgeful and try to use the entire 24-hour session, you will see that the stats just don't make sense. And that's why you see a lot of people going who use 24-hour profiles for like intraday trading. They're like, well, you know, this doesn't work. Of course it doesn't work. It's meant for regular trading hours. It's not meant as a full 24-hour measure. Now you can mush profiles together and look at volume profile, which will give you a slightly different outlook, and we have that on our so it's something similar to this visible range. We have it on the Bloodtech MP as well. So for example, if you go to, let's go to a 4-hour chart, for example, on copper. And now if I scale out, you will see we're in a very high volume node. So what does that mean? It means we are potentially in an accumulation phase. So high volume node, visible range established. It means that we are probably going to take a while before we exit this, but it also gives us a potential to play that range until it's broken, right? So it serves a couple of purposes. If you want to go deep into the analysis of the actual price patterns, I actually prefer supply and demand for it, because it actually looks at the formation rather than just a general smushy volume profile, which can, you know, again, it all has its own thing. So you have high volume nodes, low volume nodes, and there are expectations for each of those. But when it comes to the actual formations and validity of some of these areas, I prefer supply and demand analysis, which means you will be looking at how the price arrived there. For example, if I look at how, so let's maybe use, okay, so let's use this move from a drop up here. So how did we arrive here? We turned around all the way up at 454, and then it did a very smooth move away. There was no stuttering. It was like we turned around and it was a very orderly, medium strength move away. However, then we sort of made a little speed bump here, which if you look very closely, devil is in the detail when it comes to analysis of price action in this matter. You will see that at the end of the day on this candle, when we hit this area, so let me just try and overlay that a little bit better. So if you assume that this big candle here didn't exist at the time, all you were looking at was this candle that day, and then you hit this little speed bump, and look at what happens. You have a selling wick. That's an intraday opportunity to scalp it for maybe about 30 or 50 ticks from a larger time frame speed bump into the next sort of time period. And this one was actually Asia into London. So so in the first 3-4 hours of London, you had an opportunity to scalp copper from a larger time frame area. Now, because this is just a speed bump, you wouldn't, and it's in the middle of nowhere, you wouldn't expect it to be reactive for like any larger movement. So there is definitely a methodology behind it of what zones qualify for some bigger moves and which ones don't. However, learning to combine all of that, I started with supply and demand thanks to a friend of mine who actually got me into trading in 2007, 2008. He's the one who taught me about the value of a good trade location and all of that good stuff. So I didn't really bumble around too much with moving averages, RSI, MACD divergence. I immediately went to price action. Well, pretty much immediately. It was probably within the first 3 months. When I sort of expressed interest in trading, my friend was very kind to sit down with me and to really help me out with this sort of analysis. But I kind of went deep into it with my own observations, my own journaling, and it was incredibly helpful. So, if you look at how the market behaved, we actually had a daily supply that got created from this area. And then once we touched it, it became an area for a larger swing point, which led eventually to the breakout. Okay. So that is something that is pretty useful when you're looking at larger time frames. When it comes to smaller time frames, though, these zones do not work quite the same because you suddenly have to match the time of day, make up your mind whether the move was made out of hours. Like, let's say you see a consolidation and you're like, oh, it's a price agreement, that's a supply. Is it though? Because if nobody's really trading that particular product, like for example, let's say equities, generally not largely traded in Asia, specifically DAX. They don't really trade DAX during Asia. So it's very range bound. It looks range bound. And you're like, wow, that's a valid, let's say valid demand area. It's not, because it was made out of hours. So you need to have enough volume when you're looking at points of reversals in order to decide whether that was an actual valid move or not. But let's move on from that. I mean, it's such a big subject. This is why I have a course so that I don't have to talk about this every single time. It wasn't some big business decision, on my part, and it still comprises only a very small amount, like the courses that we sell. I'd never really spend much money in advertising them or anything like that. I mention them. People know I have them. If you're interested to know how I find my levels, that's where to go. Our main website, which is an entire sort of learning platform. But I've never, gone down the route of like, let's make this into some massive business, right? It's there to serve a purpose. If you want to learn, go and learn. And it's also why it's a slightly more expensive thing, because I don't want 1 million people on the course and then going, yes, I'm like brilliant, right? So that's not the point. The way my courses came about is purely to maximize my own time, because I found myself explaining these things over and over to every single person that I was working with who was interested, right? And it just became very laborious. In my private life, I was chatting to people all the time. My husband started getting annoyed with me. And I decided to start putting everything on a small website. Made a little YouTube video in 2015 when I still had big purple rock star hair, which is still up there, embarrassingly. So you can see that is not so confident because I wasn't a presenter then, and I found it very odd to speak into a camera. But yeah, so here we are many years later, and now we have nearly 10,000 people on the course over the last sort of 5 years, which is absolutely incredible to me. I never thought that a weird order flow / supply and demand / market profile course would be generating that amount of interest. But yeah. So yeah, it serves a purpose. If you want to know how to analyze all of these, I explain the times that I use for value areas It is 70%. I can see somebody asking what value area in percent you use. So I do use Dalton's guiding, made up a word there. So 68% point, whatever it is, 0.2, I think it is, kind of like the distribution curve by the mathematical standards. But, you know, we round it up to 70%, and the results are pretty interesting because my 70% value areas, we've tested them to death, and they are very, very reactive. Like, for example, if you see copper, we are actually just reaching the value area now. So London value, from the way I do it, is 415.26 roughly. Well, 415.25, let's say. You can see that we did go over it, but it's reacting to it. So if you get some kind of a dedicated reversal here, this is now a reversal from value low. But if it goes higher and it manages to go into the value area, technically that's a value acceptance. But there's a problem here because we have a very, very small value area. So that setup to me is not, it's not that juicy because there's not much profit margin. For the value acceptance, you expect the price to rotate to the other side of value, and then that's it. That's your trade. The highest statistical probability of a value acceptance is that you will reach the other side of value, right? Anything over that, yeah, it can happen. You know, and in fact, there will be days when we overshoot. But for the most part, when I see a small value, to me, that's not really much of a profit margin on the setup. You know how options have intrinsic value, like how much profit they have depending on the strike price versus the underlying price? Think of it the same way. So how much value, intrinsic value is there in me getting involved in a trade that I know has a target at the opposite side of value? And if that's just a scalp, to me that's not worth enough money, enough time, enough effort, right? So I want to only take the trades that will give me enough profit margin, generally 3R, but for like minimum 3R, because I want to take it off at 2R or 1.5. So I want to have that flexibility in order to have a larger risk reward. I want to be able to have enough space to get to the target and then allow for a margin of error as well, and still get a statistically viable target. So hopefully that makes sense. All right, let's have a look. We answered that one. So who's this? This is Christopher Miriam. Am I reading that correctly? I use value area high and low as entry points for NQ. I trade only the rollback to the mean method. I enter 120 points after or before the area. Should I add more confluence? It honestly works to now. Well, I would say if it works, don't change it. It does sound like you're doing mean reversions, which are actually a part of what I teach as well. So basically, when you are within the value area out from the outside, you have a potential for mean reversion to value. That's a great setup on the days when you can get it. And you don't really need that much confluence. However, for me, I would prefer that the bounce from the mean reversion happens from something. Like usually it would be a call or put option level. Or maybe if we are pretty early in the day, you can maybe look at a break of the initial balance. I don't know what entry you use, but for those sorts of setups, I use either a bounce from VWAP overnight, if it's somewhere in the vicinity, or the break of the initial balance. So those would be my entry points. And then I target the edge. And that works everywhere. You know, that works across the board with one caveat. The open or the distance from the open to the edge of the outer value, edge of value, cannot be more than about 1%, because then the whole probabilities break. Now, that number will slightly migrate depending on the product that you're trading. So, for example, for YM, anything over 0.7% distance from the open to the value area, the mean reversions are meh. They're not really high probability. It might make an attempt to it, but it sort of fizzles out before we get there because it's too large of a space. You already presumably had a very large day the previous day or the overnight session. So to then ask for yet another big day, we would have to be in some sort of a semi-apocalypse stage like we were in COVID. And we had mad amounts of liquidity, 700 tick open from value, and crude oil goes straight to it. It's like, okay then. Now, NASDAQ does move a lot, but again, when you scale it down to percentages, we come back to the same sort of numbers. So anything over 1% distance of open to the outer value edge, it is not the best mean reversion because it's too far. And I would say that's more of a reprice because of something that we had, usually FOMC, rate decision, something like that, rather than kind of going, oh my God, the profit margin is massive. And then you find that you end up in a neutral day and you're like, what's going on? Well, it's the hangover from the previous day when we had this big move and they've just made all their money and they're chilling, right? They're not looking to trade anymore, which is why then you have market makers doing their pinging and bouncing, but no committed directional moves anywhere. So that's something that happens after very, very large moves by quite some frequency. Do I trade personal or fundeds? So I actually trade three types. So we have a corporate account. I have my own personal account, which is kind of meant for like more aggressive positioning. So there is a decent amount of cash in there, but nothing like in the corporate one. And then I trade the funded accounts. Now, because of the nature of what I was doing with the YouTube channel, I have like funded accounts dotted nearly everywhere because I wanted, every time people come to me, they're like, oh, what do you think of this company? And it just so happened that during COVID, a lot of them came up. So I actually have funded accounts all over the place. Some of them expired because I just never really used them. But I remember at one point, I probably had about 20 of them or something in like different companies on different size, just to see how, how they were managing things, whether they were using the right calculations, whether Rhythmic was actually working properly or not. So, I had options to test all of that. I also wanted to see whether the company was paying out or not. And then some of them went under, as we know. Some of them are now going under in futures, which is why Topstep has brought this new rule. I know that many people, there's like so many conspiracy theories going on, man. It's like, no, it's because of the this and that. Well, I had a very, very brief chat with Topstep compliance person, and it's definitely because there's chatter in the industry about the regulations coming. So whoever thinks that it's not, if you think you're going to be able to run your multiple things and getting paid out of SIM forever, the only reason why we can do that is because it's a gray area currently regulatory. So it's not illegal or anything, but it's a gray area. It's a new industry, so there's no laws for it. Just like when crypto came out, there were no laws about it because it was a new asset class that was unregulated. You can't regulate everything, but in the futures, it's a they do a pretty good job of protecting people. And if you think that this is just Topstep making things up, have a look at EU. Have a look at what happened to CFD companies in the EU. We had the regulators from Italy and Belgium, I think it was, stepping in as the first line of resistance to go, what the hell are you guys doing? You've made it into a video game? Like, they were really not happy about it. And as a result, all CFD companies are heavily regulated now. So you can't just come up with a CFD. You actually have to do a whole bunch of regulations in order to offer it to the public. And because they are considering this sort of trading to be talking to the public, all of a sudden companies have to be registered, right? So it's like a huge shift that happened earlier this year. With the blow up of my Forex funds. So that was the repercussion of CFD and Forex space. And then the regulators in the US also got wind that US residents are trading CFDs. Now that's illegal because there's a legislation called the Dodd-Frank legislation that specifically forbids USA residents to trade CFDs. But there was a loophole because Forex people, Forex brokers, and all of these Forex prop firms were like, well, we're using a Forex broker, but under the hood, they also offer CFDs. And technically, we're not pushing anything onto the live market, so USA residents can sign up. Yeah, gray area, loophole, yes. What happened to it? Closed. FTMO, no longer operating in the USA as a prop firm. They're now brokerage. They still can operate for other people as a prop firm for, more regulated side of the EU. But what happened to all the CFD prop firms in the US? They went by the way of the dinosaur. They don't exist anymore. That's why. That's not, CFDs have suddenly disappeared. That's the regulator stepping in and saying, oi, what the hell are you doing? So that's why I am suspecting same thing is coming in the futures industry, and Topstep are just trying to get ahead of that. So if you're delusional that this is not going to happen and that they're doing this purely to protect themselves and to get more money from live traders who are profitable in sim, there's a bit of that, of course. This is a company. They're absolutely allowed to mitigate risk to the company, but at the same time, they've always been the pioneers in the space. The futures prop industry exists because of Topstep. Let's never forget that little tiny fact that all of these other firms would not exist if they weren't for Topstep. So, they've always led the pack, and it's funny to me because I was there when live sim wasn't a thing, right? When I first got funded with Topstep, we had a two-step process. So you would be trading your combine, you would pass your combine, then you would be into something that was called live evaluation prep or something like that. So you were basically required to stay within an even tighter risk parameter where your daily loss limit was now the weekly loss limit. And you had to still reach a target whilst doing that. Now, I wasn't too happy about the two-step process, but I think that was such a good exercise because it really prepared you for the live. And then when I was trading, you would just go straight into a live. There was no sim funded. What was that? So because of that, you were immediately in the live market. You were exposed to the fills that were very realistic, and it was just like a very long-winded way to get to a funded account and prove yourself that you're not a lunatic and that you can be trusted with live, and therefore they just pushed us into live. So, it doesn't say that it's going to increase people's penchant for blowing up accounts very quickly, but it certainly did prepare you better. I feel nowadays with all of the casino and gamifying the industry that everyone is just YOLOing accounts. Everyone's just YOLOing accounts. They're like, oh, daily loss limit. I've got 500 left in the account, but 3K loss limit. It's like, no, you've got 500 left in the account. And, as the whole casino thing started happening, I was guilty of this as well. I would size up way too much. But I'm kind of glad that we're going back to the old days, sort of, so to speak. We're rolling it back to be a little bit or a lot more mindful about the position sizing, going down to utilizing micros a lot more. And can I just say that back in the day, there weren't micros? Like when I got in with Topstep, micros were not a thing. So it was just the minis. Therefore, if you were in a 50K account, you still had to trade one mini. And back in those days, I was going for the 150s because it was always offering me a little bit more room, especially with the daily loss limit that was mandatory at that point. But yeah, that whole second step that they had, yes, it was a pain, but it really made you size down and test whether your system still works even on smaller size. Can you reach the target of, whatever it was, $9,000, while still having a $3,000 weekly loss limit? There's a very different way to think about it. So maybe as an exercise, because I am trying to get people to not size up like lunatics. Make sure that you set exercises and tasks like that for yourself. So maybe don't use the entire 3,000 daily loss limit in one day, but just say, well, the next 2 weeks, I'm going to practice not having a drawdown of more than 3K. I think it would be very, very helpful. Okay. So yeah, went a little bit off the tangent there, but yes, I do trade 3 types of accounts: funded, personal, and corporate, which is my company that I share with another partner. D, when you trade CL, do you look at any correlated assets? I look at all of them. So I look at everything across the board, which I wouldn't recommend for a new trader, because what I'm looking for... Okay, before I go into this, I have to give you a little bit of a background of what I do on the mechanical systems creation side. So for years now, we have created mechanical trading systems that have varied amount of strategies, and one of them is, one of them used to be a co-integration between various baskets of forex pairs that were back in the day running on the carry trade. So we would be using yen, and we would be using traditionally currencies with a higher interest rate, such as GBP, Aussie dollar, and New Zealand dollar combinations. And I am quite well versed in looking at those correlations because I worked on those systems, right? So when I'm looking at the entirety of the market, several equities, all of the metals, even though I don't trade all of them, and all of the energies as well, like heating oil, natural gas, gasoline futures, and yes, crude oil. That gives me an overview of whether we are in a disconnected day, so whether we're actually risk on or risk off, or no correlation whatsoever. And that will somewhat allow me to get a better overview of what I should be trading. So now, of course, you can have a gamma exposure change midday. And that means that if we were moving really well in London and then we come across these levels where the gamma exposure flips on the day and suddenly the New York session is dead. That can happen too, right? But to me, it's still very useful to see whether equities are moving, what's moving out of the equities as well, not just like one singular NQ, which means absolutely nothing. So the way I look at things, I look at options data, I look at all asset classes, and then I sometimes, if I have enough buffer in the account and enough size, I will actually run multiple positions. And I will typically run, I have a maximum default position size, which on one of the accounts for me is actually 40 lots. And that allows me to let's say have, maybe have 5 lots in gold, just in case that moves. But then also have a similar position in silver, just in case that moves and gold remains fairly range bound. And vice versa. And then I can partial the positions between the levels in crude oil and gasoline. Because, sometimes crude oil doesn't move, but RBOB moves a lot. So, to me, it's a better way to partial the position sizes. Unfortunately, because of the tightness of the prop accounts, I'm not really, unless I would always trade just micros, which I suppose would be still something. But I wouldn't be able to do the same kind of strategy and partial my risk dotted around multiple active positions. So it's a bit of a different way of doing things. And, if you're a more novice trader, it's probably an overkill for you. But, for me, we have whole systems where, the levels are all already spewed out on the chart. So I don't even have to, do these, where's value, where's that. We have systems that will tell me when it's time to look at something because it started moving or it broke supply and demand. We have alerts that just do a pop-up in my face. They go, hello, we've broken the supply, we're moving, have a look at me. And then, there are levels there of interest that will basically be on the screen as a potential trade. So it's a very different way of me actually just doing my own decisions here, because again, it's a correlation type trading. It's more like running different positions in an effort to see where the volume is. So, it's very interesting, but I think if you're a novice trader, you're nowhere near that. So, and I say novice, meaning anything under 5 years. All right, so let's see. Mike D says, "Hey D, nice to see you. Been a long time. Are you?" Yes, indeed. Are you using any service for your option levels, or just looking at open interest, stalking first the free expirations? Yeah, I mean, you can stalk free expirations, but if you notice in level 3, you will find a new lecture. So as you know, we are CPD certified. So it's not just a random course. We actually have to review it every so often. And then if there is a need, if the market has changed or there's enough questions from the students to warrant a tweak or to warrant an additional explanation, I will create a new lecture. And that's exactly what's happened this year. So from what I remember, you were in gold, I think. So you should be able to see that lecture in level 3. What number is it? I can't quite remember off the top of my head, but I think it was in chapter 2, and it says using options data for additional confluence or something like that. And there is a service in there that I mentioned as well. So have a look at that. That's the service that I use. And actually, this Friday, is it Friday? Let me just check that for you guys. My own schedule. Yes, so actually on Friday, at 12:45, I think it's going to be at 1 p.m. Eastern on their channel. We are going to have Anne-Marie and myself for the Mentor Q webinar, because I've been talking to them. So it is Mentor Q, right? I absolutely love what they're doing. So I agreed to go and talk about how I use some of their levels. So that's going to be happening on Friday, this Friday. So if you're not doing anything much for Thanksgiving after dinner, lunch, or before dinner, maybe come and join us. Yeah. So yeah, basically Mentor Q is a company that I found out about from Anne-Marie. Now, their levels are taken from the options. I don't just use that. I still use my own methodology. And then when they happen to line up with my own outlook, I will either use them as a target or as a bounce point, depending on the context. But I think it's a very good way to simplify the options data down to one line on the chart rather than looking at the option expiries. But if you've traded options before, you should be able to see the similar sort of outlook and similar levels. And even intraday flows, gamma flow intraday. Now, why did I do that as an update to the program? Is because we have actually come up to nearly 50% of 0DTE options accounting for volume in intraday trading of ES. That is a crazy amount of volume. And this is also why we've seen the shift from some of the more sophisticated levels, which are still used by more sophisticated traders, to VWAP being really important, because we have nearly half the amount of retail investors who are using VWAP. And naturally, that's going to be an area that a retail investor will be like, yeah, VWAP, I've heard of that. Yeah, let's go short or long of VWAP. It's probably one of the simplest strategies that will work. But it's because we suddenly have a whole bunch of people from the retail side trading 0DTE options, right? And it's very important to see where their outlook is. And in fact, to me, when we're at all-time highs, anytime we go into an all-time high, the only way to really see where the levels lie with some sort of confidence would be the options data, where they're looking at for their calls and puts. So to me, that would be the one way to look at it. But another way would be to find the levels with the highest calls and puts that are far enough away from the current price in order to get an extended move up to them that increases the likelihood of the price reversing from them. So primarily, I would be looking at the calls and puts with the highest interest as reversal points. Only if they're like sort of smushed together like we are on crude oil. So let me show you a crude oil chart. I really don't like what's going on there today. Look at this. So we have one call resistance that we've smashed through, another call area at 70. Then we have my ADR high right up there. Then we have put support. Then we have GEX2, which can also act as a pretty decent level. All of them smushed in the same area. So what are we to do on those sort of days? I'm expecting chop in crude oil in between all this. Because there's too many of them, right? There's too many things that can put a wrench in the works in order for me to have like a really nice, smooth uptrend without drama. And we're already seeing that. Look, this is a 30-minute chart. Look at the way the candles are. We go up, we wick down. We go up, wick down, doji. We go up, we wick down. We go up, a little bit of a wick, but really don't go anywhere. Just slightly closing above the previous high. That's an uncomfortable move up. That's terrible, right? I want to see a smooth trending move if we're in a trend day. Okay? I don't want to see all of this nonsense. And yesterday was exactly the same thing. Look at it. One smooth move during the initial balance, but also wick up. Then wick up, wick down, end up as a bear candle. That's very hard to trade. It's very difficult. Like those sizes of these wicks are from 58 to 71 ticks. This is a 71 tick. So what does that mean? That I need an over 70 tick stop loss in order to survive that if I'm in a trade. Like no matter how you try to manage this, unless you had a very wide stop, at some point crude oil would have come and got you. It would have smacked you across the face and then continued. And then same thing, if you were scalping, but even then, what do you scalp off of? Because I didn't really have any levels until we got very, very late in the day. And then I ran the tiniest trade at the end of the day that I made like 14 ticks on. It's like, yeah, brilliant day. Very difficult when it's wicking around, but still having a trend. It's the worst day possible. Trend day, but you can't really do anything with it. Very difficult. So that's what crude oil does. But whenever I see these sorts of levels smushed very close together, I'm calling a chop day today. I'm calling a chop day because I don't really see this. Unless we get some risk on or risk off news, I really don't see this turning into some nice smooth day on crude oil. Despite the fact that we rolled into the new month, despite the fact that we may have a possibility for recovery here. We are in some 4-hour demands that we've been bouncing from several times. But, we'll see. Okay, let's have a look at some more questions. What is my criteria when entering the trades? That is a loaded question. I probably have about 20, maybe even 27 criteria for different setups, different market states. Because I'm a systematic trader and because I look at everything. No, do not open windows. No. So basically with the with these entry setups, you need to yes, I know that I say that I have like 20 of them, but when it comes down to it, you need to have a level, so location, direction, how you enter. Those three have to be spot on. So as soon as you have a level where you're either or, you're unsure whether you want to go long or short, immediately that's a problem, right? If you were an algorithm, if you were a machine, you have to simplify it. That is the part where we all say keep it simple, right? If you're looking for a breakout, don't then go fading that move. You're looking for a breakout. If you're looking for a fade of that move, don't then go breaking out into a breakout trade if it's turning around on you. So have one idea, commit to it. If it doesn't work out, move on to the next level. Don't do paper cuts. And that is the reason why I have many different criteria. So, for example, I have different levels. That's mainly where the criteria is for the different setups, because one will be, let's say, we go up to the value area. Depending on the size of the move that we had in the run up to it, I will decide whether to reverse that value or whether to go with value acceptance. The bigger the move and the bigger and the more time we took to reach that area, it leads to more probability of a reversal. But if it's somewhere nearby and we kind of run up to it with quite some speed, like let's say in one 30-minute candle, that opens up a possibility for a value acceptance. So it's not going to be an either or. It's like, oh yeah, maybe we bounce from value, but maybe we go into acceptance. No, the proximity of the value to me, in my algorithms, tells me whether I should go long or short there, right? And then, for example, if we have a level that we've smashed through, like, for example, right now we have GEX2 that we've gone over. So do you go long from GEX now that we've smashed through it? I would say no, because it's too close, right? In fact, if I would go long anywhere, it would be either from this visible range point of control where we also have the overnight VWAP on crude oil, or if we never really get there, but we kind of bounce from VWAP, however, then we rise above this previous core resistance area, that entire zone becomes game for entries. Now, this is the part of the human. This is something you can't really code very well, because you would have to continuously go, is it under the core resistance? Did it touch VWAP? Is it under core? And then have this loop that's continuously testing for whether we are over or under. Now that subs memory, that subs CPU, very heavy on the on your computer, and it would slow the algorithm down. So you then would need some additional optimizations to get that to work faster. Now this is where my expertise is these days. I've got to say I have slightly moved away from completely manual trading because some of the parts have been largely automated, but I still have to be the one to click the button. It's not like, oh yeah, you just let the algorithm run and whatever. You have to decide which one you're going to run at what time. So that's what I do in my company. So basically it's not me necessarily all clicking buttons. That's what my personal account is for, and these accounts, right? But I would say that, it's much easier when you have some really hard-coded stuff telling you, hey, this is the setup, this is what we're doing, is this appropriate? And then my job is to decide on the day type and decide whether it's the right time of day to actually run that algorithm. So it's not about just running one and doing whatever, right? It's a bit different. Okay, let's have a look at more questions, and then we're going to finish it up. We have 2 more questions, and then that will be it. Do I still use a quarter of average session range as a stop loss? Okay, so guys, big difference. Default maximum stop. What does the maximum stand for? That you shouldn't go over it. You can go under it, under the formula that I've given, but you can't get over it. So the quarter of average session range is just so that you don't go over that. If you go over that formula, what's going to happen is that you won't have enough space for comfortable 2-hour multiples. But what do I say in the program? You can also go down to 1/6 and 1/7 if you wish, but at that point, unless there's some human interaction there, the algorithms broke down in returns. So that's the only thing that's there for. It's not the default stop loss. Oh, look at the session range and divide that by 4. Maximum stop that you should be using by that formula. Big distinction. It's not the only stop loss, right? You will frequently see me use a 35 tick stop even though we have 200 or 300. But once we go over 400 and 500, that's the point where you need to start looking at changing the formula. I've used 35 ticks on crude oil for 12 years now. Well, actually, it's been increased by 5 because when I first started, I was using a 30 tick stop. During COVID, I was using up to 70 ticks. Why? Because we had massive ranges. It was enormous. And then they stopped trading crude oil. So, they suspended it. So be very careful in the details that I put in the course, because it doesn't say use that be all and all. Just divide it, that's your stop loss. No, that is your maximum stop loss that you should ever be using. Otherwise, you won't have room. There's a reason for it. So no room for a statistically viable target introduces a whole host of problems. So you need to have effectively at least 3R, 1R for your stop loss, and then more room to reach the 2R. And that's why, or 1.5 or whatever. So to have a little bit of wiggle room somewhere within the range in order to reach a statistically viable target on the day. And then also if you have a slower day, quieter day, so that you don't have just 0.5 R maximum profit when it's only moving 70 ticks for the entire session. So all of that is in the methodology for a very good reason, but be careful with the detail, okay? Many people just gonna go, she says that, okay. And then they listen to the lectures second, third, fourth time and find little things that you missed on the first run. So rewatch the lectures. They're there. A lot of people, we're actually running a little, quite a big discount actually on the Silver Plus. So, check it out if you wish. But it requires you to really go through the lecture, go through it again, go to the live markets, come back to the lecture, get more gold nuggets about what I'm talking about in there, and then keep applying it. Usually it takes people 2 years to really get everything that I talk about in the lectures, because there are many nuances that will make or break your trade. And I should probably go and rewatch some of that, because like I said, I've been more on the mechanical side of things, and I did notice some of my manual skills have gone a little bit flimsy, so I'm going to try and tighten that in the coming months. But you get a little bit complacent sometimes, and that's never a good thing, but that does mean that you have to pull it back and, practice more effectively. That's all it is. More practice, you get better. And I'm talking practice of deliberate discipline, right? Practice of tight risk parameters, not in stop loss, but position size. What's your maximum loss limit for the day? What's your profit target? What is your early exit strategy as well? Things like that. It always takes practice. It's kind of like being an Olympic athlete and always having to be at the top of your game. Otherwise, you won't be Olympic athletes anymore, right? So it's always ton of practice, ton of drills, ton of this, ton of that, to keep your skills sharp. If you don't, we've all seen them slip. And we see it in those of us who have been trading for a long time. Every so often we slip when we go, the other end. And it's like, oh yeah, that's what I used to do. Why am I not doing that now? But the difference being is that generally we can all pull it back pretty quickly. Now, trading live, it's a whole different thing, because you have the broadcast, you have the questions, you have everything. You're not sitting there fully immersed. So it's difficult to do this live, especially if you have other people, if I have guests on and stuff. I find it extraordinarily difficult to track what's going on with the trade, because it's an entirely different skill. I'm running a broadcast. So, it is a different ball game. But at the same time, I do enjoy having other people to interact with and to talk to, because this is a very lonely job. It is lonely. All right, let's take one more question, then I'm going to finish it up. But I do have some plugs for you, so don't go anywhere. Don't go just yet. Shubham Singh says, Dee, can you please explain the concept of inventory in market and volume profile? It's just whether they were short or long. So all of the prices that you see, this is inventory. So what happens when you have too much inventory? Let's stick away from the markets. You have a company that has that sells something, right? So let's say that you are selling what should we sell? So we're selling, let's say we're selling TVs, okay? We're selling TVs. And you know that there's Christmas coming and that maybe some people will want a new TV for Christmas. So, or many people will want TV. So you look at your demand from the last year, right? You look at where the demand was last year for TVs and you buy stock because you need to have stock, right? Now, let's say that this year something happens, like we had COVID, right? And suddenly there's no Christmas, nobody's buying presents, nobody can go to see family. So now you've bought a whole bunch of TVs to sell, but nobody is buying it. What's going to happen to the price of that stock? You have too much supply, but not enough demand. It's going to fall, right? So that's exactly what happens to these prices. Whenever you see the market stalling and turning around, it means that there's not enough interest to buy these things, or let's say these TVs over here, and suddenly the market falls. So when that happens overnight, it means that the other guys who were trading overnight, Asia, us in London, it means that they typically, if they got too long or too short in the overnight session, you see this thing very frequently, where the market will turn around for the New York session. Completely the opposite way. Why? Because these guys got too long. Now, you can see something similar happening now. We had Asia that went up, and then towards the end of Asia, when we finished Tokyo, Eurex decided these guys were too high and tried to take it lower. But because it's such a small exchange, it's not really that major, it didn't work. So they hit the next major level, which was VWAP, and they brought it back up. So what's going to happen now? This is another thing that you can look at intraday. So if London was long, unless you have an outlier day caused by some kind of a headline risk event or something, you can expect that at some point during the New York session, you might see a reversal of the trend that we had during London. If the move was too big, it was like so big, sometimes they just turn around and they end up in a neutral day type, like a range bound, so nothing happens. But they still got too long or too short and they couldn't go any further. So when you apply my analogy of using stock of TVs for Christmas versus COVID outbreaks, think of that when you think of inventory in anything, really. Inventory overnight or, when relating to a previous session, it's all the same thing. And same thing when I talk about supply and demand on larger time frames, right? Supply and demand. Why do we call it supply and demand? Well, because presumably by the time that these guys got down here, there was a big demand for TVs, right? And they were like, guys, we need more TVs. And then they didn't have them. And then suddenly they're like, actually, guys, we have enough TVs. And now the demand is growing, right? So the prices are rising, but now we're starting to stall out. So why are we stalling out? Well, I don't know. Maybe we're basically running into the problem of having too many TVs again. So that shifts to oversupply. Oversupply will cause failure in falling prices, right? And this is why we have in futures contango, which is a normal market condition when cash, aka spot markets, are usually lower priced. If you look at CFD, that's spot, and you look at a futures price, unless you're very close to expiry of the month, they will be different. And usually cash prices are lower than the futures prices. That's called contango, and it represents the normal market. But if we go into backwardation, it means there's either a problem with the quality or with the supply of whatever's going on in futures or with the actual underlying commodity. And you will see backwardation where suddenly cash will be over futures, right? And that's when the cash prices are more expensive than the actual futures. So it's a very interesting thing. But, once you understand even a little bit how supply and demand works in pricing, it does open up the possibility of going, hey, we've got a price agreement here. Like, what is consolidation? It's a price agreement. They couldn't go any further, so they're consolidating. They ran out of buyers, right? And that's why consolidations sometimes lead to the opposite side. They lead to liquidation. So if you learn to look at all of that, like right now you can say that this was an accumulation, so consolidation, and now we have a markup phase. Whether it continues, I don't know. There's a 4-hour chart. It's a massive chart. So when you drop down to a lower time frame, you can then maybe start to go, okay, well, what am I looking for here? We have just unglued ourselves from an accumulation. When did that happen? Well, it happened overnight. So it's not as relevant, because I prefer consolidations to happen in active trading hours. They're more relevant because you have so much volume, and if nobody is going anywhere, it means there's something off, right? So you usually have a range bound day, or it's pending reversal. So consolidations intraday, especially on 5 minutes and 15 minutes, especially 15 minutes, they're very important, and they shouldn't be ignored especially when they're happening around very, very important levels, like, calls and puts, value area edges from the previous day, VWAP. So look out for those cues. Don't be so kind of glued in. I'm doing a breakout. Yeah, you're doing a breakout, but the price is consolidating. What does that tell you? Oh, it's going to go. It's going to go. It's not going to go. It's not gone for like an hour and a half. Give it up. So, at some point you have to use objectivity to just go, okay, I'm wrong. Now, I'm fine being wrong, right? I'm fine with all the trolls going, yeah, you're a shit trade. But that's because I know that I have a long-standing win rate of 43% with 2R multiples. That's a winning system, however you spin it, right? So I've got pretty thick skin. Sometimes I do like to get into a little bit of a cage rattling match with some of them, giving them a dose of their own medicine. But generally, whenever you see prices stalling out on a relevant enough level, objectivity has to come into consideration, right? So on platinum, because we're running out of time, let's just use the very, very quick example. We had a bit of a stall out here. This is a 100-tick chart, so some sort of a VWAP on a 100-tick chart is probably not, or it's not always representative of a true VWAP, but in this case it is. So they stalled out. So what do we need to see here if the move past VWAP is going to continue? We need to see volume, right? We need to see a committed move that holds above. Otherwise, this is now potentially a consolidation. Now, we tried to go lower on platinum, but we keep pushing ever so slightly higher. That's not a true consolidation, right? A true consolidation looks like little soldiers. Let's have a look at a 15-minute chart. Yeah, so if this was a true consolidation, you wouldn't have all of this. You would have, let me see if I can find one. Let's go to a 5-minute chart. I want to see if I can find a decent consolidation. They're all a little bit messy in platinum because it's a thinner market. So let's see if I have one in crude oil. So none of this is true consolidations. Okay, so here is one. This one here. So I'm going to delete this. I'm going to show you this. So basically what's going on here? We have opens and closes in a very, very tight range. So the bearish engulfing that you're seeing here is not a true engulfing because it never smashes through the low of the previous candle. So that's a range bound market. The next one tries to go higher but never closes above the first candle that started consolidation. The third one attempts to break out but fails, closing inside a range. And only once you kind of move away from this whole area here, so much further on, you have a resolution of the consolidation. Why? Because that's the first candle that is completely closing outside of it, opening and closing outside of previous consolidating area. So again, devil is in the detail when it comes to these sort of things, and that's useful. So rather than staring at super low time frames, getting caught up, you would recognize that this is failing, it's a consolidation, it's not going anywhere, and then you would wait for the resolution before you get involved. And sometimes you have to wait forever. It's like you sit here. That's why I have, things like cooking, dogs, playing video games, anything to keep you away whilst you're waiting for the market to show you what it wants to do. All right, so that is it. Let me just do the plugs for you, and then I'm going to run. So we've done the lockout feature already. Now, the payout club, traders who are located in the US, so very important, traders located in the US, if you've had over $5,000 in payouts, you can join the payout club, but they will only send out the hat and the badge if you're in the US. And you will be able to request that during the main broadcast. I, for some reason, don't have the link there. The link is taking me to Trustpilot, which is my next thing. No, I'm not supposed to do that today. Okay, so never mind the link. So if you want a payout club, you're in the US, check the main broadcast. They will be dropping the link there. Now, we are almost at 100,000 members in Discord. Can you imagine that? That's a huge number, guys. If you haven't checked out Topstep Discord, you have all of the lovely coaches in there. So check it out if you're looking for trading buddies, if you're looking for more explanation. All of the coaches that are currently active in there are more than happy to help you, and they're very, very knowledgeable. So check it out. 100,000 members. It's absolutely crazy, right? It's amazing. Now, I do have to tell you that with the upcoming Thanksgiving holiday in the US, although we don't celebrate Thanksgiving in the UK and EU, we will not be live on air. So everybody's taking a couple of days off. So Thursday and Friday, we are not doing anything. We are not doing anything but presumably stuffing face with a whole bunch of good food and spending time with family. But like I said before, I'm going to be a little bit more busy because I will be on with Anne-Marie for the Mental Q webinar, which I'm going to be sending a newsletter for my market stalkers so that you can check it out. But on Sunday, December the 1st, we are continuing with the market kickoff for the 4:45 p.m. Central. And guess what? Nick Fortick is back. He's had his kid, so he has his little girl now. He's been in newborn heaven all this week. They're finally home. And he's back. How awesome is that? He's like new dad, but he's like, yeah, I'm back. So respect, Nick. Total respect for you doing that for us. So check all of that out. We are, like I said, off air Thursday and Friday this week, and we're back with Nick Fortick on Sunday. Thank you so much for being here with me, guys. This has been fun, as always. No trades today. Couldn't really see anything that was catching my eye. A little bit messy for the London session today, but we'll see whether that changes later on. Until tomorrow, which is Wednesday. Wednesday will be the last day this week that we're on air. Have a good week. Don't do anything super stupid, so make sure that you're following your own risk rules, recognizing when your mental game is off, and try to pull it back, right? Try to get rid of those muppety behaviors and to keep that prefrontal cortex engaged at all times. If you notice your monkey brain starting to play silly games, go and do some weights, go and take a walk, have a break. I know it's very difficult, but with practice it does become easier. Use the new lockout features to give yourself a break. You go on tilt, lock yourself out for a couple of hours or for an hour, even for 30 minutes. Just give yourself that break. Very, very useful tools here at Topstep. And that's it. I'm going to finish it up. This has been TopstepTV London session. I'm Deeyana Angelo. Take care.